Welcome to the Deep Dive. Today, we're cracking open a really interesting one, JM Financial Limited.
Yeah, JMF.
Our sources are framing this, well, not as a simple buy and hold at all.
No, definitely not. It's much more of a, let's say, high risk, high reward situation.
A special situation turnaround play,
Yeah.
right? And it seems like it's at a real crossroads.
Exactly. A pivotal inflection point.
Yeah.
And what really defines it is this core internal conflict.
Okay.
Think of it as a good bank versus a bad bank fighting it out inside JMF.
Good bank, bad bank. All right, break that down. What's a good bank?
So the good bank is really the powerhouse. It's that legacy investment banking franchise, the core profit engine.
That's the bulk of the profit, isn't it?
Over 70%, yeah. Plus, you've got the platform AWS that's wealth and asset management.
Ah, the part that's plugged into India's big financialization story. Household savings shifting.
Precisely. That's the long-term structural growth play within JMF.
Okay, so if that part's so good,
Yeah.
something must be,
Yeah.
well, dragging it down. The bad bank.
That's right. That's the bad bank. It's mainly a high-risk wholesale lending book. Lots of real estate exposure there.
High risk.
Oh, and also the distressed credit business, the ARC. That eats up a lot of capital.
Right, asset reconstruction.
Yeah.
And how bad is the overall picture there?
Well, look, the numbers speak for themselves. The firm's consolidated gross non-performing asset ratio, it was at an alarming 8.7% as of September 2024.
8.7% GNPA. Wow. Okay, that's serious pressure.
Huge pressure. And that internal pressure met, well, a brick wall externally.
You mean the regulatory crisis this year? That really forced the issue, didn't it?
Absolutely. Catastrophic governance failures, frankly. You
Right.
had simultaneous bans hitting them, both the RBI and SEBI.
Yeah, I remember that. The SEBI ban seemed particularly bad. What's the detail there again?
SEBI banned them from acting as lead managers for public debt issues. Why? Alleged irregularities.
Which were?
Essentially a major conflict of interest allegation. The claim was their lending arm was funding clients to subscribe to the very debt issues that their investment banking arm was managing.
Oof. Okay, yeah. That's not good. No wonder management had to pivot hard.
They had no choice, and the pivot has been aggressive, extremely aggressive.
How would Chris?
Look at the wholesale loan book. They've shrunk it by 52% in just 1 year.
52%. From what to what?
From around Rs 7,500 crore down to approximately Rs 3,570 crore, just like that.
That's a massive de-risking, but shrinking that fast, doesn't that burn bridges? Or hurt the wholesale franchise?
That's the tightrope, you're right. Their answer is to change how they operate in that space.
Meaning?
Moving away from holding the risk on their own balance sheet,
Yeah.
shifting to what they call a distribution, syndication, and alternatives model.
Ah, so use the IB relationships to find the deals.
Exactly. Originate the deals, but then sell them off. Syndicate them, distribute them to other lenders, and just earn the fee.
Capital light. Fee-driven. Makes sense.
Much less risk on their books.
And who benefits most from this? This cleanup.
Well, the big winner internally seems to be the retail side. Specifically, JM Financial Home Loans. That's the good mortgage book.
Retail mortgages. Growing fast.
Very fast. PTAC, profit after tax, was up 49% last fiscal year in that segment.
Impressive.
And management's guiding for more. They want to grow that book to Rs 10,000 crore by FY30.
Okay.
Plus, there was that recent stake sale. They sold 2.1% of the home loan business to Bajaj Allianz Life Insurance.
Strategic validation. Right. Hints at a potential future IPO for that unit.
That's certainly the thinking. A big potential value unlock down the road for you, the investor.
Okay, so transformation underway, but it's still messy. Okay. Which brings us to valuation. The stock trades way below peers, doesn't it?
It does. A price-to-book ratio of about 1.6 times.
Okay.
Compare that to a pure-play wealth manager like 361.
Which is trading at.
Around 6.5 times price-to-book, a huge difference.
So why the big discount for JMF?
Well, the market is essentially saying, show me. Right now, JMF is still seen as a lower ROE, high-risk conglomerate. Its return on equity is only around 12.6%.
Not exactly stellar.
No, it's not a clean play on that structural growth story yet. The bull case, the reason you'd invest, is if they successfully complete this transformation. They need to earn that higher valuation.
Right. So summing up our analysis then, it seems pretty clear JMF is absolutely not a lifetime investment kind of stock.
No way. Not with that governance history and the complexity.
It's more like a 3 to 5 year turnaround play, something you need to watch really closely.
Active monitoring, quarterly at least. You need to see continued execution on shrinking that bad bank and growing the good bank.
Okay.
Which leaves us with a final thought for you, the listener. Think about this. These crises, the governance failures, the bad assets. They were self-inflicted,
Completely.
but they forced management to finally focus on the high ROE core strength, the IB and wealth management.
So the question is,
Yeah, the question is, does that swift, decisive action slashing the bad book by 52% prove they've truly learned their lesson? Are they committed to this capital-light future? Or is that inherent conflict risk, the one SEBI flagged between lending and IB, just too deeply baked into the model to ever fully overcome? That's the bet you're making here.